On today's episode, we are going to take a look at Tattoo Chef. The stock is up after releasing a few news that they are going to acquire a few companies. On today's episode, I am going to take a look at the things I do like about the acquisitions, but there's also some stuff I don't like and investors should keep an eye out for. If this is your first time here, make sure to hit the subscribe button, don't forget to hit the thumbs up, and stay tuned here on YouTube where I live stream taking a look at stocks you want me to look at. So let's get started. Alright, so right now we are going to take a look at Tattoo Chef. This is traded under the NASDAQ as ticker TTCF. And it's currently sitting at $17.95. It is up about 1.4% for the day. If we were looking at it earlier throughout the day, it was up almost 5% on the recent news. Just a quick recap, they are a $1.45 billion market cap company. And from its 52-week high, the stock is down about 35%. So it's definitely seen a crazy correction. So let's take a closer look at this recent news. And for those that don't know, Tattoo Chef is a leader in the plant-based food industry. Today on May 3rd, they announced that they are entering into an agreement to acquire New Mexico Food Distributor Inc. and Karsten Tortilla LLC. They are acquiring both these companies and collectively they will be referred to as Foods of New Mexico. This transaction will be approximately $35 million in cash, and I'm super excited that they're actually doing a cash deal because this company has a strong balance sheet. If we take a look at their most recent earnings, they reported about $131 million of cash and short-term investments compared to about $2 million in debt. So even with this transaction, they'll have about $90 million in cash, and it really wouldn't build up too much of debt on their side. We don't know how much debt these other companies have, so it's something we would have to take a look at and once they give us more information. But because they aren't mentioning much debt growth, I would assume that these companies are coming with very low debt. But again, as an investor, something we should keep an eye out. So this transaction is expected to close in early May. So now let's take a closer look at the companies they are collecting, right? They are acquiring. This is Foods of New Mexico, and it's a prepared food company that produces ready-to-eat Mexican food items for both retail and food services. And right now they have two facilities. The first one is in Albuquerque, and it currently produces Mexican food, including quesadillas, burritos, and other handheld items, as well as sauces. So we can see they are trying to expand the overall products that they're doing. It's no longer just frozen foods. The second facility is in Karsten, and it is a brand new facility and that will enable them to have extensive tortilla manufacturing capabilities. It's crazy how many tortillas are they thinking of making. Tattoo Chef believes that at full capacity, Foods of New Mexico can contribute up to $200 million annual revenue in the next 2 to 3 years and create significant value for all the stakeholders. That's pretty impressive, right? This is a company that they're purchasing for $35 million, and in the next 2 to 3 years, they believe the revenue growth will be over $200 million. So great deal in both the balance sheet, right? They're paying all cash, and a great move, in my opinion, from Tattoo Chef's management team. Alright, so now let's take a quick look at some of the strategic benefits. And then after that, I want to share some of the things I didn't like about this deal. So first, this is going to diversify manufacturing capabilities, right? They're going to enter more into the Spanish, Hispanic, Southwest food, which they believe is about a $20 billion market. The second benefit is going to expand production capacity. Right now, they have two facilities, and those two facilities, they'll be able to continue to innovate and continue to develop new products. So great move, again, for Tattoo Chef. I'm really liking this acquisition. The third thing, and this is probably my favorite thing, is it's going to accelerate their expansion outside frozen food. Right now, Tattoo Chef is mainly known for their frozen foods, but with this type of acquisition, it's going to move them into things like snacks and other ambient products that, again, is expanding them outside that frozen food market. All right, so next I want to take a look at the new outlook Tattoo Chef gave us with this new acquisition, right? They gave us an outlook in their previous quarter for the full year of 2021, but obviously with new capabilities, with new products, they have to update it. But before we do that, let's take a quick listen to today's sponsor. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services The Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month, you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. So if we take a look, revenue, their new outlook represents revenue of 235 to 242 million. That represents a 58 to 63% year-over-year revenue growth, where they previously gave us a guidance of about 49% growth. So first thing we're seeing, it is going to help increase the amount of revenue by about $13 to $20 million for the year. That's great news. This guidance excludes any revenue from their Carson facility, which is currently not in operations. So that this revenue growth can actually be even stronger than this, because the company expects to update the guidance when the production begins at the facility in the upcoming months. Next, their gross margins, they gave us a range of between 20 to 25. This is actually in line with what they gave us on the previous quarter for the full guidance, so that's still the same. One thing that has changed dramatically is their adjusted EBITDA range. Right now, they're expected about 2 million to 4 million, where previously they were expecting somewhere between 8 million to 10 million. So there is going to be an increase in that region. They're going to be losing out some money. I wonder where that loss is going to be coming, because this is adjusted, so I don't think it's really going to be impacted by the overall transaction. So that's something to keep not mind for. And they did not give us a net income range right now. And in the last quarter, they gave us a net income range of 2.5 to 5 million. If we actually look at the adjusted EBITDA decrease, which was about 6 million, in theory, it means that this upcoming year will be a loss in net income for this company. So that's something that investors might not like. Overall, I think one bad year is good, in my opinion. It's understandable for them acquiring this, for overall increasing their market facilities and everything else. So I would give them a year, right? A year of negative earnings right now. Not a bad thing, in my opinion. Overall, I am really happy of the overall transaction. All right, so now a quick look at my thoughts. First, Tattoo Chef, the acquisition was a great move. Strong move, because it is a cash only transaction, and they have a very strong balance sheet. The second thing, the benefits coming from this deal, in my opinion, are great. It is great for the overall company's expansion. The only thing I want to say I didn't like was that this transaction is gonna make them not be profitable in earnings, and they have lost a good portion in adjusted EBITDA. And like I mentioned, adjusted EBITDA usually don't include types of acquisition costs. So that's something that I'm gonna have to keep an eye out for the full year. Why did this company decrease their adjusted EBITDA margins by so much? Another thing I want to mention is this company gave us guidance of revenue of $235 million on the low end, not counting the other facility plan. That gives a price to sales ratio of about 6. So I do think right now, even with the nice uptick in price, the stock is still sitting at great levels, and I wouldn't mind adding on. So I hope you guys enjoy. Take care, have a good night, and see you next time.